Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss monetary policy and economic recovery. Phil, it's great to see you as always. Welcome back to Trade Talks. And although we already know the Fed raised their forecast to growth and inflation, but reiterated that loose monetary policy would remain in place for a while, the bigger question is, Phil, should we believe what they're saying?
And I think that's what the market's doing with what they're doing with rates as well. Is the big question is whether we'll overheat or whether we're going to have inflation in the future. And the Fed doesn't want to preempt it. They don't want to have a taper tantrum like we had last time we tried to normalize rates. That would be counterproductive given how many people are still out of work, how the services sector has only just started to recover. But I think if we look out 2 or 3 years from now, there's a risk, and people starting to talk about it, that by purposely waiting for proof that we have a broad-based recovery, it might be too late, and we might have sort of indoctrinated people into inflationary expectations, wage growth spirals. And so it's going to be a really tricky couple of years for the government to navigate, just given how much stimulus there is in the system, especially with vaccines rolling out and everybody pretty keen to get back to normal.
And let's turn to COVID-19. Vaccines are rolling out, as you said, the weather's warming up. The question is, how come cases are still on the rise?
Yeah, it's interesting, isn't it? There's a few states that are causing it. Ironically, it's the states that weren't hot a couple of months ago. It's New Jersey, it's New York, where we live. It's Michigan, Florida. So it's only 4 or 5 states that are making up about half of the new cases. A lot of that is the B.1.1.7 variant, which is proving to be way more contagious, obviously. But if you look at the data, the death rate is falling much faster than the new case rate. And so what's starting to happen is it's reported the new cases are in younger people because the older people are the ones that are vaccinated. The new cases are coming out of schools, which have been reopened. And so you can start to see, basically, I guess what you would expect is the older people are vaccinated, they're safe, but the younger people are potentially opening themselves back up to the wider social groups a little too early. And because this variant is more contagious, it's spreading, but it's not having the same impact on mortality.
Well, that is good news at the end of the day. And it kind of makes sense, right? March Madness just got finished. Spring break just got finished. And you saw, kids that age congregating. So it makes sense when you think of it in those terms. Now, services and employment data show that we are in growth mode. What are you seeing in terms of supply and demand?
Yeah, so obviously, when we've seen excess demand in things like groceries and cars and houses and home building products, we've seen inflation, and we've talked about that before. What we haven't seen is the services sector, which is a lot of the really badly affected by coronavirus sectors. The hospitality, entertainment sector, lots of restaurants and hotels still. Airlines have much less customers than they used to. Despite that, their prices are lower as well. So they've been deflationary. What we're starting to see, though, is with all these vaccines coming out and with people able to get back to more normal life, with restaurants opening, with people able to think about booking summer vacations, we're starting to see the services sector hiring pick up. We're starting to see job availability increase. And the PMIs, not just for manufacturing, but for services too, have started to spike. So there is definitely some evidence that the hard hit services sector, which is the bigger part of the economy than manufacturing, is now starting to pick up as well, like we expected, but the data is starting to show it.
Right. And if we take a look at our last chart here, we can see that with spending as well. It's suggesting that we're on that way back to normal.
Yeah, I mean, interestingly, if you look at the home building chart, it's actually showing a turnover where people that were rushing out to buy one-family homes and sort of move out to the suburbs where they could be socially distanced, it seems like that rush might actually be starting to slow. The mortgage applications have come off. The home sales have come off a little bit. So maybe we are starting to see people pivot from the sort of coronavirus inspired panic situation where you're looking to quarantine and looking to get into a bigger house with a yard, and people are actually really looking forward to getting back to normal, moving away from spending money on their houses and starting to spend money on their holidays.
Yes, let's hope so. Looking forward to that one, Phil. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.